a shotgun, a rifle, and a four-wheel drive, country boy can survive.
Hello again, this is Professor Watts, and today we're going to talk about asset valuation. We're building on the knowledge we've just learned and learning about asset categories and the kind of income assets earn, and we've talked a lot about the competitive market process. So we're really ready to put a bunch of things together here and talk about the factors that determine the value of productive assets. So just a quick review. We talked about the type of assets and the types of income they earn. And we saw that there are these four categories: labor or skill, which earns wages; money or capital, which earns interest; land or fixed assets, which earn rent; and knowledge or entrepreneurial initiative, which earns profit. And today we're really focused on the valuation of the capital assets or fixed assets, things that can be owned, bought and sold in markets. So we're really kind of focusing on those two central categories of interest and rent. And as we've discussed briefly before, in competitive markets where assets can be traded, the rent return will ultimately collapse to interest. We're really kind of building on that concept of the price of an asset changing until its yield is equilibrated to some kind of benchmark opportunity cost rate of return. Okay, so this is our basic question. What determines the value of a given asset? The answer is how much income it earns. And of course, the higher the income, the higher the asset's value. We want to know specifically how high. Well, that depends on other assets, alternative assets. It depends on what else I could do with my money. If I'm in the market for assets, I have cash and I want to invest it, I'm thinking about one specific asset. I'm going to think about it in comparison to basically all the other assets I could potentially acquire. And when I use the term there, alternative assets, I hope this concept pops into your mind that we've discussed frequently. It's a core principle of economics: opportunity cost. Opportunity cost, remember, is the value of foregone opportunities or alternative courses of action that you could have taken. When we talk about opportunity costs with respect to asset valuation, we'll say the cost of owning one asset depends on the prospective income you could have gotten from other assets. And we can say something like this: asset X must have a risk-adjusted yield at least equal to asset Y. Why is this the case? Well, if asset X doesn't have a yield that matches asset Y, why would I ever bother with asset X? I'll settle for asset Y. Of course, the riskier asset X is, the higher that yield has to be in order to compensate me for the risk. What do we mean by this concept of yield? Hopefully you're familiar with the term, but if you're not, it's pretty simple. It's just the income expressed as an annual percentage of the value. And the formula is quite simple. You take income, the annual income stream, divided by the value, multiply it by 100 to express as a percent. So for example, you have a government bond priced at $10,000 that pays $300 interest a year. The yield is simply the 300 divided by the 10,000, 3%. So any asset with similar risk, and of course government bonds would be considered very safe assets because it's very unlikely, especially for the US government, to go out of business. And even if the government gets into financial difficulties where it's struggling to collect enough taxes to pay its debt, it has the handy expedient of a central bank that can print money for it and essentially use that freshly printed money to pay off its debt. But don't take my word for that. Listen to what the former chairman of the Federal Reserve Board of Governors had to say.
Are U.S. Treasury bonds still safe to invest in?
Very much so. I think this is not an issue of credit rating. The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
Government bonds are considered extremely safe. It's virtually ruled out that you won't get your nominal money back. Now, the government might wreck the value of its currency and it might inflate away your yield. We'll talk about that later on. But any asset with a similar risk should have a similar yield. Any asset with higher risk is going to have a higher yield. And that leads us to an equilibration process. Assets that have a higher yield than that threshold, that opportunity cost yield on the alternative benchmark asset, those assets are going to be more attractive to people. They're going to want to buy more of them, so we'll see an increase in the demand for them. As demand increases, their price increases. As price increases, their yield will decrease. And how much will it decrease? Well, the price will keep going up and the yield will keep going down until it just matches that alternative asset. And it's very easy to think about that just from a basic supply and demand framework. Here's our initial supply and demand, equilibrium, price and quantity. And what happens if based on this price, the yield, the income divided by the price, is greater than the threshold, the comparative yield on alternative assets? Well, this asset's more attractive, demand increases. Go D2. And of course the price will start to rise, P2. If this yield is still above the threshold, demand can still increase, D3, price up to P3, D4, P4, so on and so forth, until we reach a price where that yield is equilibrated to the threshold yield. In like manner, let's consider an asset with below threshold yield. This asset is less attractive. If I sold this off, I can invest the money in that higher yielding asset. And so I will. People want to sell, which shifts the supply curve to the right. And that's going to drive the price down. How far? Until the yield is equalized. Once again, we'll think about that in terms of basic supply and demand. Here's our initial equilibrium. And in this case, we're going to see a rightward shift of the supply curve, an increase in supply. So we'll go to S2. And then the price goes down to P2. And if that yield is still below the threshold, the supply curve can continue shifting right until the price falls sufficiently to make that yield, based on that new lower price, rise until it equalizes the threshold alternative yield. So that's a basic equilibration process there. It's very simple, really, that ensures that over time asset prices adjust until the yields are equalized. In finance, you'll learn about bond price adjustment. This is really just a special case of this overall asset equilibration process. You often hear it stated in this form, the inverse relationship between bond prices and interest rates. Well, that is a feature of the equilibration process. Here's how it works. If interest rates fall, the older bonds have relatively higher rates, and therefore a higher yield. Investors find them more attractive and bid their price up until their yield equalizes to the new lower rate bonds. That's exactly what we did in case one, with demand shifting to the right. If interest rates rise, the older bonds have relatively lower rates and therefore a lower yield on the basis of their previous value. Investors find them less attractive and they're going to sell them off, and that value is going to fall, the supply curve shifting right, until the yield equalizes that on the new bonds with higher interest rates. In the general case, it's just long-term assets, and you can think of many kinds of long-term assets are really pretty similar to long-term bonds. You can acquire it now for its capital value, and it pays you an income stream over time, sometimes indefinitely. Farmland, for example, is basically a bond that could pay you potentially forever, although it does have variability in its yield due to factors like the weather and market forces. It also depreciates, so not exactly the same as a bond, but you can think about it in the same way, and then the valuation of the asset is definitely determined in the same manner. It's determined by comparing this prospective yield on this asset to alternative assets. So we could say there's an inverse relationship between asset prices and interest rates. If interest rates fall, higher yielding assets are now more attractive. They see their price bid up, demand shifts to the right until the yield equals the new lower interest rates. Remember, the same payment is now divided by a higher value, so the yield falls. And vice versa, if interest rates rise, existing lower yielding assets are less attractive. They're going to be sold off. The prices are going to fall until the yield, which is the annual income now divided by a lower capital value, rises. So the yield is going to rise until it equals new higher interest rates. Now, of course, there's risk adjustments here, and riskier assets are always going to have to yield more than less risky assets. But we could factor that in, and we can say that after adjusting for that risk, they still equilibrate. And this leads me to what I call the Bocephus principle. This principle of the inverse relationship between asset values and interest rates was actually captured by Hank Williams Jr. in one of my favorite country songs of all time.
Preacher man says it's the end of time. Mississippi River is a-going dry. Interest is up and the stock market's down, and you only get mugged if you go downtown.
So notice there in the song he says the interest rate's up and the stock market's down. Well, that's true, and that's just the equilibration principle at work. If interest rates rise, that makes the yield on new bonds or new bank accounts relatively more attractive and increases demand for them. And if you want to increase your demand for that asset class, you're going to reduce your demand for other asset classes comparatively. So people might be selling off other kind of assets like stocks, and stock values will fall. And then what happens to the yield on stocks? You can think about the dividend yield on dividend paying stocks. It's going to rise as their value declines, and we'll see this market process set in motion until these yields are equalized. Now, of course, this process never stops because there's always new information coming in, and there's always kind of particular factors for particular assets, but this is a long-run tendency of markets. Market forces are constantly working to adjust the asset values to equalize the yields. Now, let's get a little bit mathematical on this. I want to give you some tools that you can use to to actually try to calculate valuations. We want to find the value that makes a given income, a given payment stream that an asset generates, equal to a given percentage yield on that value. Because we could go and look up interest rates. So we could say, I need to beat this interest rate, because I could take my cash and passively invest in a bond portfolio or a bank account or what have you. So I have a threshold interest rate, and now I want to say, what formula do I use given that my known interest rate threshold, my known payment stream that an asset generates, to find its value? Well, I showed you the simple yield formula above. Here, we want to use the present value formula. I hope you're familiar with this. Present value, that's the value today. The value today of an asset that persists into the future and generates a continual stream of income, of course, is discounted by the interest rate, the value of future money being worth less than current money because of time preference. So present value formula, of course, you take the payment, and for us, this will be the annual income the asset generates, divided by 1 plus the interest rate, to the n. And n, of course, is the number of periods. For us, this will be the number of years. And that is going to be our threshold interest rate. It could be tedious to work present value calculations, but fortunately we have a very powerful and handy and user-friendly computer program to do this for us. So move on now to Excel, where I'll show you how to set up present value calculations. We'll work with present value formulas to do some valuation of different kinds of assets. And I try to pick assets that maybe are familiar to us, and assets that maybe some of us might own someday, if not own already. Let's jump to the spreadsheet. So here's a valuation model I set up for an acre of farmland. And I have this set up to where Excel does calculations based on the numbers we enter, including, of course, the interest rate, and then some crucial assumptions about the productivity of the land itself. So we can put in the yield of the ground, bushels per acre. That's what's in this box right here. And this is a variable. Note that if I change this, of course, the valuation changes. If I make it more productive, from 160 to 200 bushels an acre, the value goes up, but I'll keep it how I had it. The expected crop price. This is, I have a corn crop in mind, but we could do soybeans too, we could do wheat, whatever. So here's the expected gross income of the land. That's simply a product of the expected yield times the expected price. And then we have to factor in costs, and I've just put some numbers in here for all the cost categories: seeds and chemical, the depreciation of your equipment, labor for your operators, land depreciation. And these are just made up numbers, but of course someone with knowledge, entrepreneurial knowledge of the actual business and the unique properties of his own land would be able to put in accurate numbers here. Okay, then we have the net income from the acre of ground is simply the gross minus all these costs. And with that income, with that net income and this interest rate, we can do our present value calculation. And notice I'm just using Excel's present value formula here. Now let me show you how that works in Excel. In Excel, you enter the formula in this fashion: equals PV. And notice here it asks you for the rate, the number of periods, the payment, the future value, and the type. So there are 5 potential arguments we need to enter into this formula. And of course, our rate is given by the cell C4, the chosen interest rate. And of course, once we get this set up as a spreadsheet model, we can just enter a new interest rate into that box, and then it's going to automatically instantly give us a new present value calculation. I have interest rate is C4. Now for the number of periods here, for farmland is a really long-lived asset, so I just put in a large number. Any number above 30 or 40 is going to give us a present value calculation that is going to be approximately equal to a perpetuity calculation. So I basically enter an arbitrarily large number for that. And the payment is F15 here, the net yearly income. Now, future value, we don't need to enter anything because we're kind of anticipating that there's no residual value after the asset's completely used up. But of course, this asset is never completely used up, and the dominant factor in this calculation will be this large number for the number of periods. So future value is basically irrelevant here. And then type, I have 0. Actually, for future value, I have 0. And for type, if we leave it blank, that's equivalent of a 0, which is end of the period. For this calculation, whether we do end or beginning of period, it's not going to matter too much because, again, we're looking at a long time period. For shorter time periods, whether you structure the payment at the beginning of the end of the period might make a little bit of a difference. I typically go with end of the period. I think that's appropriate for farmland. You think about you own a farmland and it produces a crop, and You basically harvest the crop at the end of the year and then sell it. So it's actually appropriate to use end of the period assumption. So Excel is automatically doing that present value calculation for us. So Excel is doing this. PV equals payment over 1 plus R to the N, $200 divided by 1.06. Our interest rate, remember, is 6% to the 100th power. And we can do this ourselves mathematically, but Excel does it much quicker. And the beauty of the Excel spreadsheet model is that we can change any of our variables. Okay, so let's change the interest rate. What's the Bocephus principle? When the interest rate rises, asset values fall. Well, let's make that interest rate rise to 7%. And ready? Hit enter, and you can watch a change in value here. Value declines to 28.53. Let's go back to what we had, 6%. Let's make the interest rate fall. Let's make the interest rate fall to 5. Present value rises to 3,900. Okay. We can actually, Excel has a lot of powerful tools here. I can actually say, well, what's the interest rate that would make this present value equal to, let's say, $5,000 exactly? I'll show you something pretty neat here. You do a what if analysis goal seek. So I want to set cell F17, the present value, to equal to 5,000 exactly by changing the interest rate, which is cell C4. Excel does some calculations pretty quickly and then tells me that the interest rate of 3.91%, actually 3.91396664, blah, blah, blah percent, gives me that present value of 5,000. So there's a lot we can do here, and of course you can change all the assumptions. We can say, well, what if corn sells for a higher price? Of course, that increases the value tremendously. If you're looking at a crop price, you want to try to forecast an average, and of course that's very tricky to do. What if yield grows? Now, one thing that we could do, we won't do here, we'll keep it fairly simple, but we could presume that, well, yield might grow at a steady rate over time because of improvements in genetics and pesticides and whatnot. So we might want to set up a model where our yield goes up by 5 or 10% every year. And we could do that. It just takes a little more complex math. But we could actually base our present value calculation on projected steady growth in yield or growth in price. Okay. We change assumptions about costs. We could have costs growing along with yield. So there's a lot we can do with this, but it all boils down to this basic present value calculation. We're dividing the income by the interest rate, compounding over time to give us the capital value of the asset. Let's look at a couple more examples. Here's one. We want to find out what the capital value or the current price should be for a rental home that gets you $900 net monthly rent income. It's presumed to have a 30-year useful life, and we've got a 7% discount rate. Now that discount rate, the term discount rate is just a math term. It refers to the value by which we're discounting this payment stream. How we want to think about it economically, that's our threshold rate. So we're presuming we could get 7% real yield by investing in a broad stock market index, and that actually is a pretty good estimate of long-term stock market returns. And don't take my word for that. If you Google search S&P 500 historical average real return, and there's several sources that will basically give you the same data. I chose this one here, MoneyChimp, and it's pretty neat because you can put any date range in. You can calculate adjusted for inflation, which is subtracting the inflation rate from the growth rate or yield. Well, average earn 8.53%. That's just the arithmetic average. A compound growth rate is 6.86, so about 7%. I could take my money invested in stocks and expect to get on average 7% real return, or I could invest it in this rental home. I want value of this rental home to be such that its yield of $900 net per month, and of course we're net of all the maintenance costs and costs of vacancy and so on and so forth. You got to be really careful about that when valuing an asset that has ongoing costs. But let's presume this is the net income. So after all expenses, maintenance, depreciation, whatnot has been paid, you get $900. We need this value to be such that it yields 7%. If it yields less than 7%, we're actually losing money because we could have invested in the stock market, which is predicted to return a 7%. So we have to run this calculation to find out what the maximum price we would be willing to pay for this asset. So I've entered in the relevant things, and of course the payment, we want to annualize that, so it's 900 times 12 months. Number of periods is 30 years. There's the rate. In this one, I'll show you how to enter present value formula. So I'll type present value here. Here's how it works in Excel. Equals PV, the rate. I'm just going to click the cell. The number of periods, 30. Cell reference the payment right here. Cell reference C4. Future value, I'm going to go ahead and put 0 here because I'm expecting it to fully depreciate. Several ways you could do this. You could put in, if you think there's going to be some residual value, you could put in the depreciated value. I'll just put in 0 to make this simple. And then the type, let's just do the standard end of period. Press enter. Now you'll notice that Excel returns this as a negative number. There's two ways to kind of fix that. We want this to show us a positive number. We could either just change this to the negative present value, or we could make the payment a negative. Excel assumes that your payments are cash outflows. In this case, it's a cash inflow, but nonetheless, it's easily corrected. And let's highlight this. We've got a present value of $134,017. So basically, we're saying if you're looking at this as a prospective investment, you wouldn't want to pay more than this. This is the value or the price at which the asset yields 7%. Any higher price is going to mean the yield is lower than 7%. Let me just extend this a little bit and I'll prove that to you. Let's say they're asking $150,000. Well, with this payment and number of periods assumption, we could actually have Excel solve for the rate for us. So let's call that yield, and then we'll use Excel's rate formula. Returns the interest rate per period of a loan or investment based on knowing the number of periods, the payment, the present value, which is now the ask price, future value, and we'll call it 0, and payment type is 0. And then Excel in this case asks you to guess, I'll guess 5%, 0.05. To help it get started. Just that helps Excel's algorithm by giving you a starting point for them, because Excel is going to do a trial and error process here. Of course, with the computing power we have, it's going to be pretty much instantaneous. Okay, and I just realized I had a little error there because Excel demands that payment be expressed as a negative number, so I just multiplied that by -1, and then we can see that it did kick out a yield for me of 5.92%. So remember I said that if the price is higher, that yield is going to be lower, and remember this represents a maximum. This price here represents a maximum we're willing to pay if we have a threshold yield of 7%. Of course, if you're willing to accept 5.92%, go ahead and pay $150,000. The thing is, you shouldn't be willing to accept 5.92% on a long-term investment, because you know that 7% prospective return is out there on the broad stock market, at least if you buy into that assumption. Now, there's a lot of financial analysis, of course, is kind of deciding what is the threshold rate, what's the appropriate rate to use, and people have differing views on that. And of course, it's one of the things you kind of have to decide for yourself. Based on everything I've read, I think a 7% real return is a good long-term benchmark for a broad stock index. That's basically what the S&P 500 has done for the past 130 years or so. So I think that's a pretty good baseline expectation. Okay, finally we'll look at bond valuation problem. This is a kind of problem you get in your finance classes. Maybe you've done them already. If so, it'll be very familiar to you. It'll just be review. But we have stipulations about a bond from this fictional company. It's a 9 1/8% coupon payment. That means it pays 9 1/8% of its face value, or par value, which is $1,000. So it's going to pay $91.25 per year. Now, typically bonds pay semi-annually, but we're going to run this annually just to keep it simple. The starting year is 08, and it matures in 2019, so it's got 11 years left to go paying that yearly yield. Required return here is assumed to be 8%. So where does that come from? Well, we might say at this time period we could look out into the bond market for new bonds, and new bonds are yielding 8%. So we've got to price this old bond at a yield of 8%. Future value is going to be 1,000. Now, the way bonds work is that they repay their par value, their face value, at the end of their term. You're going to get your $1,000 initial investment back. So we do have to work in a future value in this case. A price today is just going to be its present value. Let's do the negative present value so this shows us positive. Based on these assumptions, that rate, that number of periods, that payment, that future value. Notice I'm just clicking the cells here for each element of the Excel formula. And type, we'll go with the standard assumption end of period. So Excel's telling us that to yield 8%, paying $91.25 a year, this bond would be valued at $1,080.31. What happens to the bond value when the interest rate rises? Well, watch. Bond value falls. Let's make the interest rate rise. Let's make a big drop, big increase in the interest rate, big drop in the bond's value. Let's make the interest rate fall. Big fall in the interest rate, big increase in this bond's value. Inverse relationship between bond prices and interest rates. Okay, so let's wrap this up. What have we learned here? We've learned that with open competitive markets, asset prices will adjust until their yields equalize. We learned that rent on fixed assets collapses to equal the interest rate. For instance, the price of land will be bid up until its yield just equalizes the threshold rate on a comparable risk asset. And if you're the landowner, your yield is your rent, your annual rent payment. So ultimately, you won't be earning economic rents, you'll just be earning interest on capital. Undervaluation won't persist, and undervalued assets will be hard to find because it's a competitive world with millions of people trying to find undervalued assets. And when any investor thinks he's found an undervalued asset, what does he do? He bids up its price. So I'm not saying that undervaluation doesn't exist. I'm just saying it won't persist in the long run. It's going to be very tricky to find truly undervalued assets. So to get superior returns, you've got to have some kind of special knowledge or luck. And really, both of those are hard to accumulate and maintain in the long run. And I'm a big believer in the philosophy that you can't beat the market in the long run. Now, this is okay because the market will offer you a return that could be quite nice, quite suitable. And the long run stock returns have averaged about 7% real return. Well, that's a great return. You know, that if you think about rule of 70, that doubles your investment in 10 years. So you can do very well for yourself by getting the market return, but you want to be disciplined and knowing the economics of asset valuation and the equilibration of returns will help in that regard.
We came from the West Virginia coal mines, the Rocky Mountains, and the Montana sky. We can skin a buck, run a trot line, country boy can survive.